Hi, this is Nilus Mattive for Money and Markets TV. Over the past few days, Mike Larson has done a great job of outlining some of the problems facing the global economy, and there's no doubt that they're pretty big hurdles. This explains why we saw yet another week of massive volatility and some truly unprecedented moves in the major markets that I follow. For example, yields on 10-year Treasuries hit an all-time low, a mind-boggling figure of less than 2%. Meanwhile, after a brief period of calm, stocks plummeted all over again. While the action is disconcerting to a lot of investors, I do want to point out that every time stocks sell off, the yields on dividend payers only become more attractive, especially when you compare them to those paltry Treasury yields. In fact, at least 80% of the S&P 500 index's dividend stocks are currently yielding more than 10-year Treasuries. Just consider this chain of events. First, the US government's creditworthiness got downgraded. Then, in reaction, investors mercilessly punished American companies, many of which are sitting on their biggest cash hoards in history and have the cleanest balance sheets of their corporate lives. All the while, investors are gorging themselves on the very securities that got downgraded. It's perverse. Think about it this way. Imagine that rather than downgrading the US, S&P came out and downgraded all of America's biggest corporations instead. Do you think that investors would run into Treasuries and pile into stocks? No way. So on the surface, this seems like one of those heads I win, tails you lose kind of situations. Or as one astute reader basically asked me, who has it right now, the stock market or the credit market? My answer is that both markets are at least partially wrong. Let's assume that you want to allocate some part of your portfolio to the traditional investment assets, stocks and bonds. I've heard other experts describe the entire financial system as a tall building, with safer investments like Treasuries at the foundation and riskier assets like stocks at the top. Based on this logic, even though Treasuries were downgraded, there's greater overall risk to the stuff at the top. And with Warren Buffett recently saying that the US's credit rating should still be quadruple A, you might be inclined to accept this explanation. But in reality, I don't believe things are that simple. I can see why, despite the problems in the US, Treasuries can still be considered among the paper assets with the highest potential for capital preservation, largely because of the dollar's status as the world's reserve currency. Of course, that assumes you hold them to maturity, and it does not consider the effects of inflation during the time you're holding them. So in that respect, I think investors have been extremely foolish for piling into Treasuries lately, especially because the Fed virtually guaranteed rock-bottom rates for another 2 years. At the same time, I also believe that stocks should be moving lower in response to signs of a new recession, but I wouldn't paint all stocks the same color. In fact, I would argue that conservative, cash-rich dividend stocks are clearly the better alternative right now. Like bonds, they will provide solid income throughout another recession and during this unprecedented volatility. But unlike bonds, they provide good yields, and not just good on a relative basis, but on a broad historical basis. Plus, they're backed by entities with solid financials and cash piles, some with higher credit ratings than the US government, and their payments can continue rising as you hold them. Now, keep in mind, there's the obvious risk that further market declines will wipe out your payments, even though dividend payers typically hold up better than most stocks. But I would point out that you run exactly the same risk when you invest in Treasuries, especially through mutual funds or ETFs. Bottom line, investors have been absolutely crazy to pile into Treasuries. I also think they've been wrong to sell off solid dividend stocks of recession-resistant companies. And I feel that there's a big opportunity right now for those of us who understand where the wrongs of these two markets intersect. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.